Welcome back, traders, to the Options Trader Lounge. I know it's been a while since I've made a last video, and that is because I got quite busy with my main job here in Nevada. Um, in the insurance world, end of the year stuff gets quite busy, especially in the accounting end, where you're trying to close up a lot of books and you're trying to get ready for renewals in the insurance world. So right now, this is one of my busiest seasons as rates change because inflation's kicking in, and things and prices don't seem to come down as much as they seem to say, and as what they are reporting on the news network, where things are supposedly in a deflationary mode. Prices are still seeming on the higher end, but what we are seeing across the board is the rate of inflation starting to slow down. So in this video, we are going to be discussing what we are currently seeing in the market, the US stock market. We are going to be discussing a lot of the things that need to be touched on as we wrap up the end of 2023. So without further ado, welcome to the Options Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. We have a good one for you, so get yourself a drink, sit back and relax, because we have a lot to talk about. Now, we are sitting near all-time high once again with the S&P 500. If we look back 2 years ago, all-time high is 479.98. Right now, we are currently roughly 4 percentage points away from all-time high. And 4 percentage points away does not seem too far away for the market to accomplish. I do not think that we will get it this year, but definitely next year is a possibility as we roll into 2024. And 2024 is an election year for the US economy as we start to vote in a new president. And as we know, in most cases, the current sitting president is going to do whatever it takes to allow spending to go rampant to boost up the economy, so that way the current sitting president doesn't turn out to appear as a bad president. Despite the many chaotic things that are happening in the economy, we are currently fighting 2 wars in the economy. Can you believe that? We're fighting proxy wars. You know, our men in uniforms are not on the grounds fighting these wars, but we are spending billions of dollars on other people's wars as we aid them to win the war. So that's pretty crazy. As I mean, if you really just think about the amount of spending that we're doing in Ukraine and soon to come in Israel. So that is what we are seeing here. I don't know if that's ever been in the history books where we've allowed to fight 2 wars in 1 year. That's pretty crazy to think about. But that's the US economy, and that's what the man in the White House has voted to do. So, we're on a spending rampant on defense. So that is where we're at. Now, back to the S&P 500. Again, we're roughly around 5 percentage points away. If we look at the triple Qs, we are sitting at 392.17 at the close on Friday. All-time high is 404.58, and that is roughly 2 percentage points away from all-time high. Tech has been very strong this year. If we look at it year to date, this is a roughly 46 percentage gain. This is the leader, as we can see, has done phenomenally. If you put your money into the triple Qs and literally just bought tech, you are doing quite well. Can't argue about that. S&P 500, if you put your money at the beginning of the year on January 2023, and where we sit now, that's an 18% return. So doing very well on both ends, as long as if you bought the dip, you're doing well in terms of returns. However, we are now going into 2024. We're about to wrap up this current year, and 2024 has a lot that we are going to be going into, and there's going to be a lot of things that uh, may surprise us. And as a trader, the whole goal here is to really just continue to follow the trend. The currently year to date, the trend is up. We have strong moving averages on the weekly candles that are pointing higher. We are still trading above the 200 weekly moving average. If we look at the daily candle, right, we are doing quite well as well. Year to date, we are above the 200 moving average on the S&P 500, and we are also doing very well on the triple Qs. Now, there are factors that we are very concerned about um, going into 2024. One of them is going to be the debt bubble, and that could be on the personal side, that could be a black swan event as well as the current commercial real estate collapse. We don't yet know how that is going to affect the next year, but we have to be aware that those factors are still on the table. We don't know how that's going to play out. What we do know is that this past Friday, we had strong job reports as far as unemployment. Unemployment actually went down from the previous reading of last month. Uh, it ticked down 0.2%, right? So this unemployment rate actually sat at 3.7 percentage. So that's not too bad. But what we've been hearing across the board is that the moment unemployment starts to tick up above 4%, it tends to exponentially go up because that's when things start to collapse, where spending starts to slow down. And the biggest expense that any business has is employees. And the push for AI and push for automation is a real thing. And the main expense that many businesses have are their employees. And if many big corporations such as Walmart start to cut employees, that's gonna slow down spending because people are out of a job, and once they're out of a job, they're missing out on receiving payments to pay their regular grocery bills, and it starts to infect the mind and conscience of people on how they tend to spend. Because uh, when people are strapped on cash and low on savings, they tend to slow down on how they spend. They start to move to more of a budgeting tactic, instead of shopping at Target, which is more of an affluent target market where or many big spenders typically go to. They'll start to trickle down to the Walmarts, Dollar Trees, and that could be a problem. But again, it's just like trading. If one makes money, there's another party on the other side that will reap up the benefits of those losses. So again, we're gonna see this balance and shift of spending that could possibly occur, especially seeing that we are starting to see a ramp up in credit card spending and credit card balances, and knock on wood, delinquencies, and possibly the tightening of credit as far as lending goes with the banks. So those are factors that we are, very conscious about, that we want to make sure that we are paying close attention to um, as traders, because the trend is something that we'll continue to trade off of until that trend ends. And as more and more data points come out, uh, within the next few months to next few weeks and years, that's something that we have to pay close attention to. So that's what I have for you today. It's going to be a short video, but those are things that I am personally looking at. And again, right now the trend is playing to the upside. We are seeing, volume pick up on the upside here for triple Qs as well as the S&P 500. But again, we are topping out on the MACD, which is something that I like to play co something that I like to pay close attention to as we get this crossover from the blue over the yellow, which would mean a negative momentum shift. However, we are still on the upper side of the zero line here. So it could play out to more of a buying the dip opportunity and shorting the tops as this momentum starts to shift over to the downside. Once we get a reading where these moving averages tick below zero, that is when things start to kind of fall apart as we've seen back here in September and October. As we know, September and October are typically the weakest months of the year. Again, we just have to watch it day by day, week by week, and month by month. So that is what I have for you today on the S&P 500 and triple Qs. Moving on to the VIX. The VIX is on a total collapse. Now, for the past couple weeks and days, we've been trading above this 1250 level. And on Friday, after the unemployment rate and jobs report, we ticked below 1250. Now, this is an area where we haven't seen in quite a while, where volatility is on total collapse, where it's sitting now at 1235. We haven't seen those levels for really much time. We haven't seen that really ever. So we are on the down low on the VIX, where volatility is starting to dissipate. However, this move down low typically is followed up by a pop in the VIX until it can continue to move lower, unless we get this kind of a waterfall effect on the VIX where it just continues to fall and fall and fall and fall and fall. But we are not seeing that just yet. We have to see the follow-up candles that show up after Friday. And depending on how it tends to trade, if the VIX starts to pick up again, that is something that we need to pay attention to. If it starts to swell up or we start to see lower highs and higher highs, that is something that we will pay close attention to, because that is when we need to start shorting the market and starting to put on hedges. So right now we are on a lower on all times low on the VIX. So that is something that we are currently playing into and playing and following the trend on the upside. So that is what we have here on the VIX. So take it as it is. The VIX is on collapse. We don't have really the market. The way the market is seeing this is that there's no resistance to sell the market. Instead, people are buying the market and holding off from really selling really anything, because there's two things that we're facing right now is possible more government spending, right? The and the possible ending to rate cuts. So rate cuts is one, and possible, turning on the money printer to really boost the economy from its current weakness that we're seeing. And the Fed's mandate has two things: to maintain job employment and to boost the economy. So those are things that we are watching and seeing how the Fed will react. Now, again, there's things coming up for this year, for the month of December. We have the Fed interest rate decision. That's going to be on the 13th, as well as the Fed conference. So this is going to be a very heavily watched event. Many analysts are predicting that the Fed will hold interest rates. So, that's what we have. You know, I personally think that one more interest rate hike would be good for the economy, a pause, and then cuts sometime around mid 2024. You know, uh, I don't think it's smart if the Fed really wants to tamper down inflation uh, to really, if the Fed wants to keep inflation low, the interest rates has to remain higher for longer. I do agree with that, but I do not think that I think we the market could handle at least one more 25 basis interest rate hike. That might be possible to really just cut down on the crazy spending that people are doing, just buying things left and right. You know, we are starting to see cracks. One of them being in the car markets, where a lot of fake money has been buying, luxury cars, and repos are starting to go rampant. But that's what we have here. Anyways, again, thank you all for watching the this channel. If you like this video, please go ahead and subscribe to the channel. Please leave a like down below, and if you like this video, please leave a comment, whatever you liked about this video, please go ahead and share it. Thank you again for watching, and we will see you on the next one.